When you combine the horizontal and the vertical spread together, you sort of try to get best of both the worlds, and that's exactly what we try to do when we trade the diagonal calendar. Hi everybody, welcome to today's very special video. VIX have been so low from so much time. Calendar spread, but not the usual calendar spread. We're gonna talk about diagonal calendar spread for low VIX. Let's learn everything about this, and also towards the end of the video, I'm going to tell you about the adjustments and what are vertical, horizontal spreads. It's gonna be full of learning if you trade calendars. Before I start, standard disclaimer: strategy explained is for educational purpose only. Stock trading, options trading contains risk to capital. No fluff, no gas, directly on the point. Point number one: what is a horizontal? What is a vertical spread? The main difference, there is so much confusion, right, about horizontal and vertical. I'm gonna make this clear for you, and then we're gonna go for our calendars. So here we are on an option chain so that I can explain you. First, we're gonna talk about a horizontal spread, and then we're gonna talk about vertical. So here, if you see, I scroll down, and this is the monthly option chain. Now, if I make a spread, what is a spread? Spread is that you buy and you sell, it becomes a spread, right? Now, if I have to do vertical, if I sell this strike or buy this strike and I sell this strike, maybe multiple lots, maybe same lots, this is called a vertical spread. Different strikes, same expiry. The ratio can be different, but same strike. This is when I do, this is called vertical, as the name suggests. Now let's talk about horizontal. What exactly is this? In horizontal spread, suppose I go and sell out of the money call 24,800 put. Okay, I sell this in the month of October. Okay, and then I buy the same strike in the next series. Same strike, I'm selling and I'm buying, but I'm buying and selling it in the different series. This is called the horizontal spread. Clear? Now, when you combine horizontal and vertical spread, this becomes a diagonal calendar spread. Let me show you about this, and then we're going to talk about strength and weakness and what is the recommended usage of doing a strategy like this. So here we are on an option simulator. Nothing fancy, simple simulator. Even if you trade American markets, same, the series you can go for monthly or the next month. Market currently is around 25,100, so we look to sell current month October series. October series is just near, so this we can consider as the current month. We sell this, and now we're gonna buy the next strike, but we are doing diagonal. So what do we have to do? We have to go for next series, of course, and we have to buy a different strike. It can be any strike as you know it. So what we can do is we can probably buy this put. Remember, we're selling and we are buying different strikes, different series, and as soon as we do this, the cross calendar is what we have made. Now calendar is gaining a lot of popularity. Why? Because the VIX is low. This is a good variation of it. When you do something like this, this is how it looks, as you can see, right? We are shorting different strikes. It can be any strike and different series. This is called diagonal. If you like to know ratio diagonal spread or double diagonal, I can tell you that as well. That is slightly advanced. First, I have to build your base. Now here, if you see, what do you see? That this is obviously a non-directional strategy. You can make it non-directional, you can make it bullish, or you can make it bearish. Depends on how do you like to trade it. Now, the number one question which I get asked in the comment section: what if market go bearish? What if market go bullish? In that situation, what exactly we are going to do? So I'm going to demonstrate to you how do we adjust it. I think it's going to be very useful for you. First question is, if market starts to go down and if market come here, then what is the alternative? Now, I do understand that you do not want to do a lot of adjustments, right? Suppose if market starts to go down, what should be the first level of defense is the put which we have sold. Naturally, this put will come into action. We can expect some amount of loss in this put. So what we can do is we can always square off this put, and then we can move it down. We can move it to probably 24,800. We can bring it down 100 points, probably 300 points, 400 points, depend on how bearish we are. Suppose if market jump from here to here, what do we see is that this adjustment can come in very handy. As soon as market go down, one put we can expect to be in positive, one put which we sold, naturally we expect some kind of a loss in this when we do adjustment. If you like to go a little deeper in how to adjust the calendar, I've made a video in the past. I'm going to put a thumbnail on this short video. You can learn something really good, especially when you trade needs adjustment. That can be a really good alternative. Now let's talk about the bullish. If markets start to go up, then what's going to happen? First, I'm going to move it to the original how we trade this. Suppose if we sell this, right? Now, obviously, if market do not move, then what's going to happen? We all know, right? Because remember, low wicks really test the might of a trader. This is a really good learning into the markets, like I've been saying in the past. Now let's focus. If market go up, then what exactly are we going to do in this? So if market go up, remember we are only touching one put. If market go down, we bring it down, as you just noticed. If market go up, guess what? What we gonna do? We look to bring it up, because if market go bullish, obviously the put which we have sold, we expect to that put to turns out in our favor, of course, because market is going right opposite to the put. So if market start to go up, and suppose if the move is really heavy, in that situation what we're gonna do, right? So what we can do is we can square off this put and we're gonna move it up to maybe a couple of strikes up, maybe 200, maybe 300, completely depends on you. When market comes over here, adjustment can take place when market comes near the break even, not before that. So people do adjustments very fast. Just because you know an adjustment does not mean that you start doing it as soon as you can. You got to give some time to trade to swing back in your favor. Here you see a very nice fetter payoff, obviously, right? Remember, it's a simulation, and simulation in calendar can really vary, I must tell you. In the real world, when market move up, you can obviously have a payoff like this, but payoff may not be as good looking as you are looking at right now. Now, I have to tell you some more very important points on this, how you can really maneuver. First, I bring it back to original again. Now we have come to the same original position, which we have when we create a strategy of different strike of different months. Now let's talk about what else we can do with this. Diagonal spread is hybrid between the two, horizontal, vertical. There's a lot of information available online. We make it clear in 30 seconds or less. It's very easy. Know the low wicks environment and trade logics, like I said. Calendar strategy, because it's a debit strategy. Any strategy which is debit when the wicks is low, the knowledge of learning those strategies come really handy. Whenever you have two different series involved, the payoff obviously change, it fluctuates a lot. So this thing, you must keep that in mind. Better adjustment are the ones which increases your range without increasing the margin. Like I said, we made a video in the past that can come really handy, the knowledge which you learn from the video when you are adjusting your trade, when the break even is getting breached. At least you have some kind of information, some kind of knowledge on how to deal with the situation. And this is exactly what trading is in a nutshell. When you enter into a trade, you should have a plan B, you should have a plan A, you should have a plan C, and over and above, you should have a hard exit plan if things go completely against you, how you can really deal with it. So if you trade calendar, you have another variation now, not just the variation, we spoke about the adjustments as well. We look to utilize the same margins. Thanks for watching, and I wish you all the very best. Take care. Bye-bye.